Hello and welcome to this brief video on basic accounting concepts from beachmontcrest.com, the tutorial site. Let's look at some basic definitions. First of all, a definition of accounting. Accounting is the process of measuring economic information and communicating it to the decision makers and stakeholders of an organization. Accounting information is used by an organization's managers, investors, employees, and creditors. Government bureaus like the IRS and the Securities and Exchange Commission, or SEC, also use accounting information. Accounting is generally divided into two main varieties: financial accounting and managerial accounting. The purpose of financial accounting is to create financial statements for an entity. Managerial accounting involves the measurement of financial information that helps an entity make better decisions about its operations. Bookkeeping is a part of the financial accounting process. Bookkeeping is a set of procedures that captures and accumulates the results of economic activities. Financial statements are generated during the financial accounting process. Financial statements begin with transactions and accounts. Transactions are economic interchanges. A transaction occurs, for example, when the company purchases office supplies from an outside vendor or sells one of its products to a customer. Accounts are categories used to organize transactions. Examples of accounts include cash, paid-in capital, and merchandise inventory. Concepts and assumptions used when evaluating financial statements. Certain assumptions apply when managers or analysts evaluate the financial statements of a company or organization, otherwise known as an accounting entity. First of all, they assume that the accounting entity is a going concern. This simply means that the accounting entity is not going to be liquidated. It will continue in operation during the upcoming fiscal year and presumably well into the future. They also assume that revenues and expenses should be matched. If a company earns revenues from the products it sells, the accounting process should match the costs of making and selling the products to the revenues earned from them. Otherwise, it is impossible to determine whether or not the company's operations are profitable. Transactions are recorded at their original cost with no adjustments made to reflect changes in market value and/or inflation. So for example, suppose that a company purchases some plant and equipment. The plant may go up in value by the end of the fiscal year, or the value of the equipment may decline. But all accounting entries related to the acquisition of the plant and equipment will reflect the actual cost in dollars. This is known as the cost principle.